Can a business stay profitable today without destroying its own future tomorrow? And how can you, as a management accountant, show that in numbers and reports? In this lesson, we will move from the basic idea of sustainability through to sustainability accounting and reporting exactly as set out in the CPA Australia Management Accounting Study Guide. Let us start at the widest level. Globally, sustainability is about using the world's resources in a way that meets current needs without stopping future generations from meeting their needs. You can think of it like living off the interest on your savings without eating into the capital that your children will depend on. When we zoom in to a single organization, sustainability means designing strategies so that resources are used only at a rate the natural world can replace, and so that any pollution or waste stays within levels the environment can safely absorb. If a factory consumes water faster than local sources can refill or releases more emissions than air or water can cope with, it is not operating sustainably. It is important to see that sustainability is not just about smokestacks and coal mines. The CPA Guide stresses that sustainability is broader than environmental protection or worries about running out of raw materials, and it applies to service firms, banks, and consultancies just as much as to heavy industry. For a bank, for example, sustainability might focus on social impacts of lending and long-term economic stability rather than physical resource use. There are several main objectives behind sustainability. One is recognizing the social needs of everyone, such as fair work conditions and community well-being. Another is protecting the environment effectively, which includes air, water, land, and biodiversity. Sustainability also aims at careful use of natural resources and at maintaining high and stable levels of economic growth or employment. So in management accounting terms, it is not about stopping growth, but about supporting growth and jobs in a way that can last for the long run. At the same time, the guide reminds us that business organizations exist mainly to pursue their own objectives, such as profit, survival, or growth. This means sustainability has to be balanced with commercial realities rather than replacing them. For your exam, you should remember this tension between social and environmental aims on one hand and business goals on the other. So where does accounting come in? Sustainability accounting refers to new or emerging accounting and reporting tools that help organizations make decisions not only on financial grounds, but also in line with ecological and social sustainability. You can think of it as extending management accounting to track environmental and social impacts alongside dollars. Management accountants support sustainability by reporting on many specific areas. These include carbon emissions and energy use because they show an organization's contribution to climate change and its efficiency. They also report on local economic impacts, such as how operations affect jobs and income in the surrounding community. Their role also covers reporting on sustainability-related initiatives, including corporate social responsibility programs and on sustainability-linked key performance indicators. They track the costs of preventing environmental damage, monitoring environmental performance, and preparing environmental reports. In practice, this means building these costs into budgets, cost reports, and performance dashboards. To organize all of this, many organizations use a sustainability or environmental management system, as described by the International Federation of Accountants. This type of system helps define sustainability objectives that line up with overall business goals, identify sustainability-related challenges, risks, and opportunities, and make sure that management and operations respond in a structured way. Once sustainability performance is measured, it needs to be communicated. Sustainability reporting is about telling stakeholders not just how the organization performed economically, but also how it performed environmentally and socially. This is often described as triple bottom line reporting with economic, environmental, and social results side by side. Many organizations use the Global Reporting Initiative standards for this kind of reporting. The GI was founded in 1997 and its G4 guidelines were published in 2013. From 2018, reports that claim to be in accordance with GRI must follow the GRI standards. So as a management accountant, you should be aware that these standards frame much current sustainability reporting practice. To see how attitudes are shifting, the CPA Guide cites the 2017 annual review of the State of CSR in Australia and New Zealand. In that review, 53% of Australian respondents supported the idea that sustainability reporting should be mandatory for organisations above a certain size, which the report's managing director noted was a much higher level of support than a decade earlier, when mandatory reporting met strong business resistance. The same review highlighted organisations such as Abergeldy, Arup, Deloitte, MPAPST, LexisNexis, PwC, Tata Consultancy Services, Transurban, WaterAid and Yarra Valley Water as leading CSR businesses in Australia. This shows that companies can stand out by integrating sustainability into both their reporting and their day-to-day practices, which is exactly where skilled management accountants add value. To recap, sustainability in management accounting runs from careful use of resources and protection of social and environmental well-being through to concrete sustainability accounting tools and structured sustainability reporting. As you study, focus on being able to explain these definitions in plain language and to link them to the role of a management accountant. And if this helped your understanding, subscribe so you do not miss the next topic in the CPA Management Accounting course.